it's important to have a clear business plan. So when you're thinking about what you're going to do with the debt investment, you need to be able to sort of say, well, this is where we are now. This is where we'd like to be. This is how much it's going to cost to get us there. Here are the key KPIs that we want to show at the end of this. I think, we sometimes invest in businesses that are mid-pivot, but then you're adding financial risk on top of commercial risk. So maybe having, a really sort of clear idea of where you're going with that financing is really important for us as well.
Hey, everybody. This is Andrew Bott, the founder of MeetFounders, and you are on our YouTube channel. Today, we're going to have a conversation about venture debt. First of all, what is it? What type of companies should be trying to access it? And what do folks who are providing venture debt actually look for? What type of companies, type of growth, type of past investors do these venture debt equity companies look for? So enjoy the panel. It's a great conversation on something that not everyone knows about as an option for your kind of mid-range investment. It's a great option for folks who are kind of in that mid-range level of startup investment. I think just before Series A or post-Series A, people who have gotten investment already, but want kind of a lighter touch investment for their future rounds, so they're not giving away quite as much equity. So I hope you enjoy the panel, and I hope to see you at a future panel at our MeetFounders conferences, which happen every month. Cheers.
So I'm very excited to learn about venture debt because I don't really know a lot about it. Can you tell us what does it mean for a startup and any advantages it may have, how it differs from banks lending or the traditional VC investment that we all know?
I'll kick off, and you guys, of course, add if I've missed anything. But just to explain, sort of venture debt is a financing tool that's available to startups. There's all sorts of other different types of tools, like there's equity, of course, there's convertibles, there's a range of different options, royalty monetization or revenue financing, whatever it might be. But venture debt is a form of financing that's minimally dilutive, and it's structured as a loan, essentially. And it's a loan, and a portion of our return for that loan comes in the form of cash. So that'll be an interest charge on that loan, but also a portion of our return is in the form of equity. So that's warrants, which are the right to purchase equity at a set price, which is set by your equity investors, not by us. And that gives us a little bit of upside, which differentiates us from banks. And sort of we're not the typical bank lenders, because we have incentive to act in the best interest of the company and the shareholders with that little bit of equity coverage, which is significantly less dilutive than if you took in the same amount in equity.
Can you give us any advantages of venture debt for the startups?
The first and the main advantage of venture debt is its minimal dilution, right? So if you compare it to equity, then the loan by itself is really non-dilutive and allows the founders to raise growth capital more efficiently, right? And potentially combine it with some equity capital that they're raising, or raise it sort of in between the rounds and extend their runway, or get a security cushion in case they potentially will need additional time to reach the milestones before the next raise. But I think what's also most important about venture debt is, one, I would say from our end, we see venture debt as a type of financing that is a bit more light touch than equity, and usually the process is more streamlined and can take less time and is less intrusive in companies' life. And then one other thing that I would add, and the way we think about it, is venture debt, especially if raised, say mid-round, is more signal neutral, or we would actually say signal neutral as compared to other forms of sort of bridge financing, like convertibles, for example. But I think market knows that convertibles may be giving a wrong sign to new incoming investors, whereas venture debt is really not signaling anything about the company can be arranged earlier and then dispersed in the middle between the rounds, and thus sort of provide that financing without sending any wrong signals to the market.
When you come into venture debt, actually the use cases are relatively broad. Yeah, non-dilutive form of capital, but then you can use it for event-driven financing as well. So actually, if you see some of our VC-backed businesses looking to acquire, we can definitely go and support that going forwards. You know, if you wanted to execute a roll-up strategy, so not just one acquisition, but multiple, venture debt can play a role there. You see some of these very innovative, like Amazon aggregators, I know everyone's been probably looking at recently as well. Again, venture debt plays a fantastic part in that story. And yeah, and I come back to this point, probably even just calling it venture debt is probably too narrow. This is like the way we sort of view it at Kreos, the way I view it is a non-dilutive form of flexible capital. And however that wants to be structured, whether it's a structured term loan, you can do convertibles, PIK notes, even something that looks and feels a lot like equity. But obviously, like I say, it's not looking for the same sort of return that a VC is. That's where I think a really sort of good venture debt, growth debt provider can support a management team. And, you know, all of those things encapsulate probably what we are and what a bank doesn't do, because they haven't got that same sort of risk appetite. They haven't got that ability to structure around problems. They haven't got that ability to look at the way a venture-backed business works effectively.
Amazing. Thank you, Shane.
The only thing I would just add, I think that's some good color from everyone else, is there's maybe a bit of a misconception about how risky kind of software-based or tech-based VC-backed companies are. The companies we tend to get involved with, they're in revenues, they're growing quickly, they're burning cash, and they're kind of going from a round to another round, typically. And those companies, you know, if the growth is strong, you can start to lever the balance sheet to support growth. You don't have to just finance that with equity, which I think everyone's alluded to is obviously super expensive capital if you're bullish on the growth of the business. So it's kind of a point in time in a company's life cycle where they have customers, now to sell to customers, they're rolling out maybe different geographies, and funding that kind of execution risk and that rollout risk with debt is actually pretty sensible because it should be pretty predictable. So you can start to layer in debt into the capital structure, maybe once the company's raised a couple rounds of equity and you know, they kind of know how to sell to customers, and it's just really about how does that scale. And you know, we can take a little bit of scaling risk, and it's probably not best to finance that purely with equity.
So from the startup's point of view, are there any specific goals that they need to meet in order to begin the venture debt process? Do you look for any specific criteria in a startup?
Yeah, I guess obviously, you know, again, coming from perhaps a more conventional cash flow lending type credit environment, you know, you always talk about things like the 5 Cs, like character, capacity. I guess one of the key things that the businesses we tend to look at don't have is cash flow, but you can still underwrite around that. So you are looking for, I mean, the key cash flow that we actually typically look at is, yeah, that money coming in from the VCs. So big lumpy cash flow right at the start. You typically like to come in either alongside that round or when you have good visibility over that round. And then it's all about trying to buy into the equity story, to think about, you know, do I think the next one is going to be raised in 18 months from now? Do I see good visibility over that? Is there a good runway there? So that's part of the underwriting decision. So again, do you have strong VCs in the background? Have they shown support historically? Are they VCs we've worked with before? Are they not? And then I'd say the other thing, so character. Do they have a strong management team? You know, I think all of us around the table here want to back exceptional management teams. And then all the other things that go into a conventional lending decision as well. So defensibility of the market, recurring revenue base, you know, I think we talked about SaaS businesses, all those types of things that go towards perhaps telling a good equity story, but, you know, actually recurring revenue, future visibility over revenue. Those are the criteria we look at. You know, definitely at Kreos, and I assume probably at, you know, the other sort of lenders around the table too.
I definitely agree that, you know, probably VC backing is one of the most important things that we'd be looking at, and the strengths of the VCs, and then betting on the VC story and the equity story there. But I think revenue is actually also important for us at Flashpoint, because at the end of the day, what we want to make sure is that the loan that the startup takes in the form of venture debt can actually help it grow. And in a down case scenario or in a rainy day, revenue is really what ensures that the company can pay back the loan without sort of, you know, going into financial hardship. And hence, you know, we obviously depends on the size of the loan, but we like to see some meat on the bone in the form of revenue that, you know, ensures that if something happens, the company actually has a functioning business that can actually be cash flow positive if needs be.
Something that we look at, and I'm sure we're not alone in this, is looking at the cap table of the company. So, you know, we like to see who's invested and how much, and have they gone back in subsequent rounds, things like that. We like to see supportive sort of shareholders, and that gives us quite a lot of comfort as well. And then also, really touching on also what Shane said, it's important to have a clear business plan. So when you're thinking about what you're going to do with the debt investment, you need to be able to sort of say, well, this is where we are now. This is where we'd like to be. This is how much it's going to cost to get us there. Here are the key KPIs that we want to show at the end of this. I think, we sometimes invest in businesses that are mid-pivot, but then you're adding financial risk on top of commercial risk. So maybe having, a really sort of clear idea of where you're going with that financing is really important for us as well.
We look at companies similar to VCs look at companies. Kind of we're looking at the business, and there's an element of almost like, investing in venture capital funds. We were kind of like, as an LP, how would you look at a venture capital fund? Are they a good fund? Do they support the company? Do they have experience in the space? So that's kind of, sometimes we're wearing kind of both hats, evaluating the venture capital funds and the deals with us, and then kind of operating as a venture capital fund itself, looking at the business and whether we think it's kind of defensible, scalable, unique, that kind of thing.
Okay, thank you so much, George and everyone, for joining. You can join the networking session if you'd like now. It's for the panelists and the audience as well. So I hope to see you there. Thank you so much.
Thank you very much.
Thanks.
Bye.